There are so many headlines right now telling you to start investing, buy gold, save 15% of your salary for retirement, but also avoid tech stocks because an AI bubble is about to burst. Which of these headlines are right? And what should you actually do? I spent almost a decade in investment banking, and in this video, I'm going to cut through all of the noise and give you a tried and tested strategy that actually works. I'll tell you exactly what you need to be doing not only to protect your finances right now, but to make sure you come out ahead in the long run. Let's start with part one. What is investing and why does it matter? At its core, investing is just using your money to make more money. That is it. But why do you actually need your money to make more money? There are two reasons, and both of them matter. The first is inflation. Inflation makes your cash lose value over time. Prices rise, but the money sitting in your bank account doesn't. So, if you've got $1,000 sitting in your account, in a few years' time, it might only buy you $800 worth of stuff. Doing nothing feels really safe, but it is actually a slow and silent way to lose your money. The second reason is that investing is the single easiest way to build wealth. We are living in an economy where owning assets, property, stocks, businesses, is rewarded far more than simply earning a salary. Think about it. Someone who bought a house 20 years ago has probably seen its value more than double. Someone who invested in the stock market has seen their money grow around 8 to 10% a year on average if they did it correctly. But salaries? They have barely kept up with inflation. And so if you want to stop feeling like you are constantly falling behind, stuck in this cycle of earning, spending, you need to understand investing and you need to start using it to your advantage. I know that for a lot of people, investing feels intimidating. It feels like something that is reserved for people who already have a lot of money or people who spent years studying finance. I get that. I felt that way before I got into banking. But I want to use everything I learned across almost a decade in finance to show you that it's genuinely not as complicated as the industry wants you to believe. Let's move on to part two. How does the stock market work? The stock market is one of those things that everyone has heard of, but very few people actually understand. So let me break it down as simply as I can. When you buy a share in a company, you are literally buying a tiny piece of that company. So if you buy one share of Apple, you now own a small fraction of Apple. You are essentially saying, I believe this company is going to keep growing and becoming more valuable, and I want to make money from that growth. Once a company has decided to offer shares to the public, you can buy and sell those shares on the stock market, which is basically just a marketplace where people trade tiny pieces of thousands of different companies. And those prices go up and down all day based on what people think those companies are worth. There are two main ways to make money from this. The first is a capital gain. That is when you buy a stock and the price rises. So if you buy a share of Apple for $100 and a few years later it is worth $150, you sell it and pocket that $50 profit. Simple. The second way is through dividends. Some companies share a portion of their profits with their investors on a regular basis, usually every quarter, so every 3 months or annually. It is basically the company's way of saying thank you for being a shareholder. Not every company pays dividends, but a lot of the big established ones do. Now, you're probably thinking, okay, great. So, what do I actually invest in? Do I just pick Apple or Netflix or whatever company I like the look of? You could. But here's the thing. Even picking the biggest, most well known companies in the world is riskier than most people realize. Remember BlackBerry? At its peak in 2008, one BlackBerry share was worth $144. Today, that same share is worth around $4. Back then, we all thought BlackBerry was untouchable. Nobody predicted that within a few years, we would all ditch it for the iPhone. Even if you spend your evenings reading company reports and analyzing balance sheets, which honestly most of us do not want to do, it is genuinely very hard to predict which companies will win in the long run. And that is exactly why most smart investors do not bother trying to guess the winners. Instead, they buy a little bit of all of the big companies at once through something called an index fund. An index fund is basically a big basket of hundreds or even thousands of shares, designed to track the overall performance of the stock market. The most well-known example is the S&P 500, a stock market index that tracks the 500 largest companies in the US. We are talking Apple, Microsoft, Amazon, Google, Tesla, and hundreds more. If you invested $100 in the S&P 500 at the start of 1996 and reinvested all your dividends, you would have around $1,764 today. That is a return of roughly 10% per year, or around 7.5% once you account for inflation. So instead of putting all your eggs in Netflix's basket or Tesla's basket, you reduce your risk and build a diversified portfolio by investing in an index fund. If some companies go down but others go up, you still benefit from the overall upward trend of the market over time. You own hundreds of businesses across dozens of industries: tech, energy, healthcare, finance, consumer goods, all in one investment. Now, here is something I want to address because I hear this a lot. People look at the S&P 500 and think, why don't I just invest in the best performing companies inside it? Why not just go all in on the Magnificent Seven? Apple, Microsoft, Amazon, Google, Meta, Tesla, and Nvidia. They have dominated the market in recent years, so I get why that logic is tempting. But here is why it is dangerous. If you look at the S&P 500 between 1980 and 2020, the biggest companies have changed dramatically over time. Back in the 80s, the market was dominated by General Electric, Exxon, Kodak, IBM. Investors at the time assumed those companies would grow forever. Kodak eventually fell by over 90%. There is absolutely no guarantee that today's winners will still be leading the market a decade from now. Nobody knows. And that uncertainty is exactly why diversification is the smartest approach, especially if you're just starting out. One more thing worth mentioning. It might also make sense to invest beyond just US companies. The US economy has its own uncertainties right now, and no one knows which country or which market will lead the next decade. So, owning a little bit of everything across different countries and asset classes gives you a much more robust long-term plan. Let's move on to part 3. How to actually start, step by step. Now you know what to invest in. So let's talk about how to actually do it. Here is exactly what I would do, step by step. Step 1, pick an investment platform. This is just the app or website you will use to buy and manage your investments. The most important things to look for are that it is regulated, reputable, and has low fees. This last point matters more than most beginners realize. Even a small difference in fees, say 0.1% versus 1% per year, can cost you tens of thousands of dollars over a 20 or 30-year investment horizon. So before you sign up anywhere, check the fee structure carefully. You also want to look at what types of accounts are available on that platform. In the US, your main tax-advantaged options are a Roth IRA and a 401k. A Roth IRA lets your money grow completely tax-free. You contribute money you have already paid tax on, and then when you withdraw it in retirement, you pay zero tax on the gains. A 401k, especially if your employer matches your contributions, is often even better because you are essentially getting free money added on top of what you put in. If your employer offers a match, I would always look at that first before anything else. That match is an immediate 50% or 100% return on your contribution depending on the terms, and there is nothing else in the investing world that can beat that. Step 2, fund your account. Once you have opened your account, you need to add money to it, usually via bank transfer. This part is simple. The amount does not need to be huge to get started. Even $50 or $100 a month matters enormously over time, which I will come back to in a second. Step 3, choose your investments. And based on everything I have covered in this video, you already know where I am going with this. Start with globally diversified index funds. Resist the temptation to build a portfolio of your favorite individual companies. It feels exciting, but data consistently shows that most people make less money that way than they would have with funds. Start simple. Global diversified funds first. As you learn more over time, you can get more nuanced and build additional structure into your portfolio. Step 4, And this is the step that most beginners completely overlook. Automate everything. Instead of trying to find the perfect moment to invest, set up an automatic monthly transfer. A fixed amount invested on the same date every single month. $100 a month, $200 a month, whatever you can afford right now. By doing this, you're using a strategy called dollar cost averaging, which means some months you will buy when prices are high and other months you will buy when prices are low. But over time, it averages out. And more importantly, you completely remove the temptation to interfere with the process. This is actually one of the biggest things I took away from my time in banking. I watched incredibly intelligent people, people who analyzed financial markets for a living, make emotional decisions with their own money and lose. Because knowing the theory and being able to emotionally detach when it is your own money are two completely different things. Automating removes the emotion from the equation entirely. Part 4. What if it all goes wrong? Before I wrap up, I want to talk about this because it is the question I get asked more than anything else. What if the market crashes? What if I put my money in and everything goes wrong? First, if you have invested in funds rather than individual stocks, you are already far more protected than you think. Diversification is your safety net. Even if certain companies fail or certain sectors struggle, a globally diversified fund absorbs those shocks because you are spread across hundreds of businesses and multiple markets. Second, and I cannot stress this enough, the biggest risk for most investors is not the market, it is themselves. Let me give you an example. Imagine you have been investing steadily for 2 years, and then one morning you wake up to a news headline saying, a recession is coming and markets are going to crash. You panic, you sell everything. You think you are being smart and protecting yourself. And then 3 months later, the market recovers and is higher than it was when you sold. You have now locked in a loss, and it will cost you more money to buy back in at the new prices. I have seen this happen over and over again, including with people who worked in finance professionally. Automating your investments and committing to a long term strategy is what stops this from happening. It stops you from panic selling when things dip. It stops you from waiting for the perfect moment that never comes. Time in the market almost always beats timing the market. That is not a motivational quote. It is what the data shows, consistently over decades. One more practical thing to keep in mind before you start investing. Make sure you have an emergency fund in place first. Ideally, 3 to 6 months of your essential living expenses sitting in a separate savings account that you do not touch. The reason this matters is that if something unexpected happens, you lose your job, you have a big unexpected expense, you do not want to be forced to sell your investments at the wrong time just to cover it. Your investments need time to grow. Your emergency fund is what buys them that time. So, to bring everything together, investing is not optional if you want to build real wealth. Inflation is eroding your cash, whether you like it or not, and the gap between people who own assets and people who only earn salaries is only getting wider. The good news is that getting started is genuinely simpler than the financial industry wants you to believe. You do not need a lot of money. You do not need to understand every detail of how markets work. You need a regulated platform, a tax-advantaged account, globally diversified index funds, and an automatic monthly contribution that you set up and leave alone. That is the strategy I would follow if I was starting from zero today. It is not flashy. It is not exciting, but it is exactly what works. If this video was helpful, subscribe because I'm going to be covering a lot more on investing, money management, and building real financial security. All the things I wish someone had explained to me before I spent nearly a decade learning them the hard way. I will see you in the next one.